Good morning, ladies and gentlemen. Welcome to our third class of this winter school. The idea is that we're going to finish the theoretical part of IAS 1 today, and that will then enable us to start the practical application of it next week. So I'm just going to disappear off the screen again, and then I'm going to share IAS 1. Just before we do that, ladies and gentlemen, are there any questions from your side regarding either yesterday's class or Tuesday's class? If there's anything you'd like to ask with regards to that, you're most welcome to ask now. You can raise your hand and ask in person, or you can type in the chat box. No questions from your side? Okay. Then I'm going to share the IAS 1 presentation of financial statements again. Right, you should be seeing it in front of you now on your screen. We finished last time with, what was it again, the identification matters. So now we are going to look at the rest of the structure and content. So we are starting with structure and content. Yesterday we looked at identification matters, what needs to be disclosed. We said the name of the reporting entity, the name of each financial statement, and so forth. So now we are going to look at the actual financial statements themselves. So what must the structure look like, and what must the content be? So we're going to start with this one, the statement of financial position. Strangely, as you know, there's a certain order in which you have to draw up the financial statements. You have to draw up the statement of comprehensive income first, then that leads to your statement of changes in equity, and that then leads to your statement of financial position. But when financial statements are presented in an annual report, normally the statement of financial position is presented first. Anyway, so what needs to be disclosed on the face of the statement of financial position? This is what this list is all about. They say information to be presented in the statement of financial position. So that means on the face of the statement, and when I talk about the face, I mean the main body of the statement, not the notes, but the main body. So let us see the first few that they indicate to us there are all non-current assets. The first being property, plant, and equipment. That is the one that we are going to be starting with in term 3. So property, plant, and equipment, we'll see there's a specific definition for that. It must, for instance, be tangible assets. Then we get something called investment property. Also intangible assets. Intangible assets are assets that have got no physical form, such as a trademark or a patent right, or your rights as an author. In other words, intellectual property. And then financial assets. Financial assets, that is what is very commonly known as investments. So financial assets would be your investments in the shares of another company, and also certain kinds of financial investments that are not regarded as cash and cash equivalents, which we'll be discussing a little bit later. The next two you don't need to worry about now. That deals with group structures again. DA deals with group structures. The next one deals with equity accounting. So that all has to do with more advanced group structures. This one you won't find in financial accounting too, but I know that students always find it very amusing when I discuss what it means. So perhaps let's do that. So biological assets within the scope of IAS 41, which deals with agriculture. So what is a biological asset? Now, clearly it's an asset, so it must comply with the definition of an asset. So it is a present economic resource because of an event that happened in the past that has the potential to produce economic benefits. So it's an asset, But in addition to that, it's a living thing, something that is actually alive. Okay, that is why students always find this so amusing. So I'm going to ask you to give, or I'll give you a few examples, but I'm going to ask you a few questions first. If you think about wool, wool that we knit our jerseys from, where does it come from? Where does it come from? Can you type for me there? Where does wool, real wool, come from? Type for me in the chat box there, please. Where do we get wool from? There we go, Nomi, Nkobile. We get it from sheep, right? So the sheep is the non-current asset. The sheep is sort of the machine. I know it's not literally a machine, but it is the, let's call it tongue-in-cheek, the machine that produces the product. The product being the wool, but it comes from sheep. So sheep would be a biological asset, right? A biological asset. It is still an asset. It produces a product for you, but it is also a living thing. Let me give you a few more examples. What about a company? We spoke about a company that produces wool. What about a company that produces milk products, such as Dairy Bell? What machine produces the milk products? You can type for me there, please. Again, machine with tongue in cheek. Cow, thank you, Naomi. Yeah, it's the cows, right? They produce the milk. So the cow is the machine, not really a machine, it's a living thing. But that means that is the asset, the non-current asset that produces the product for you. So that is what is referred to as a biological asset. And then my favorite, in the case of a wine farmer, where does the wine come from? If you can type something for me there, please. Where does the wine come from that is the product for the wine farming company? Yes, there we go, Naomi. You are extremely quick. You as well, Nkobile. Looks like I must find out which brand of coffee you use. Anyway, yes, from grapes. And where do the grapes come from? The grapes come from the vines, right? So the vineyards are your non-current asset. That is the asset that produces the product for you. So they are all examples of biological assets, right? So I just thought you might find that amusing. So those are all non-current assets. Then we get to our current assets that need to be disclosed. The current assets that need to be disclosed on the face of our statement of financial position are inventories. The second one, trade and other receivables. So that means it is our debtors, the trade part, but also other receivables, such as, for instance, prepayments, and then cash and cash equivalents. Now, cash is literally what is meant by cash. That is your banknotes. It is your coins that you've got in your wallet that I don't have in my wallet. And cash equivalents, as we'll see when we do IAS 7, there's a very specific definition for cash equivalents. But in general terms, we can say it is a bank account, such as a check account or current account or a savings account. There are certain kinds of cash equivalents which are not going to be classified as ordinary cash and cash equivalents, but rather as financial assets. But we'll see when and in which cases that happens. Okay. Then we just briefly mentioned this yesterday. You don't need to know about this for financial accounting 2 purposes, but just as a matter of interest, because we briefly touched on it yesterday. They say the total of assets classified as held for sales assets included in disposable group classified as held for sale in accordance with IFRS 5. But like I said, don't worry too much about that. But one example of that would be where an asset was normally held as a non-current asset, and the company changed its type of business, and it is now held as a current asset. Then it is an asset held for sale. Trade and other payables. So now we are getting to our liability side. Trade and other payables, provisions, things like a bank overdraft. One other one that we must just take note of is this one, liabilities and assets for current tax, as as defined in IAS 12, which deals with income taxes. So there you'll remember from our discussion on income tax that each current tax liability will be disclosed separately. So if we've got current tax payable for income tax, we're going to disclose it separately in under our current liabilities. If we've got current tax payable for value-added tax or current tax payable for employees tax, we're going to disclose them separately. These you also do not need to worry about now. You are going to be taught about deferred tax liabilities and deferred tax assets next year in Financial Accounting 3. So deferred tax is a whole topic in Financial Accounting 3. But at this stage, just be aware of it. You don't need to be too concerned about it yet. And then P, you can leave out for the time being. That again deals with group structures. Okay, then what we need to know, ladies and gentlemen, is the distinction between current and non-current. We find that in paragraph number 60. So there's got to be a distinction between current assets and current liabilities and non-current assets and non-current liabilities. Okay, so for that purpose, we find some definitions within IAS 1. So we're going to look at those definitions, and then we're also going to have a little discussion on it. So let's start with the definition of current assets. What is the definition of a current asset? They say an entity shall classify an asset as current when any one of these four scenarios exists, right? Any one. It doesn't need to be all four. If either one, doesn't matter which one of those definition components apply, then that asset will be seen as a current asset. So let us have a little bit of a discussion on all four scenarios here. Let's start with the easiest one. The easiest one is actually number C. They say an asset shall be classified as a current asset when it is expected to be realized within 12 months after the reporting period. So any asset that you as an accountant or you as a company, you believe that asset is going to be sold. That is what realized means. It's going to be disposed of or sold within 12 months after the reporting date. In other words, within a year after the financial year that you are reporting on now, then it will be seen as a current asset. That is why inventory normally, we'll see there are some exceptions later, why inventory normally will always be shown as a current asset, right? Because you know the quicker you can sell it, the better for you, right? So if the company's financial year ends, let's say on the 31st of December 2019, if the company has a financial year end that is on the 31st of December 2019, and you are drawing up the financial statements for that year, and you expect that asset to be sold or disposed of or realized before the 31st of December 2020, it means you're going to classify it as a current asset. Right, then let's look at the second easiest one, and that is B. If it is held primarily for the purpose of trading. The best example I can think of here is when a company invests in the shares of another company. If the intention of the company that invests in the other shares, if its intention is to hold those shares over the long term, let's say for 4 or 5 or 10 years, in order to generate dividend income from that investment, then clearly it's not going to be a current asset. Then it is going to be classified as a financial asset, which is non-current. But if the purpose of this company is to trade in shares, in other words, it's a share trading company, if they buy and sell shares in another company in order to make a profit, right? So they buy today at let's say 5 Rand with the idea to sell it in 2 weeks or 3 weeks time at R5.60 per share, that means they are trading in the shares of that other company or many other companies. So the primary purpose of buying shares is to trade in the shares. So in that case, it will be a current asset. Right, so now let's go and have a look at number A, which is a little bit more complicated to perhaps understand. But don't worry, you will. We'll just talk about it. You will understand it. An entity shall also classify an asset as current when it expects to realize the asset or intends to sell or consume it in its normal operating cycle. So there it means we have to understand what is meant by its normal operating cycle. So this is a little bit of an exception to the general rule. So here they say even though the asset might be held for more than 12 months, longer than a year, they're only going to realize it more than a year after the year end, it is still regarded as a current asset if it is going to be sold within the normal operating cycle of that company. So let's maybe think again of an example here. The best example that I can think of here is in the property development industry. So let us imagine the company, what the business that this company does is to construct large blocks of apartments, flats, right? So they're going to be constructing this building over a period of 3 years. Let's say it's a real skyscraper, right, with 50 floors. So they're going to be erecting or constructing this huge block of flats, but the intention is to sell each of those apartments, each of those flats individually to private households, right? Then it means the operating cycle of this company is very long. It takes them 3 years, let's say, to actually finish the construction of that block of flats, but it is still intending to sell those blocks of flats because it is still their part of their operating cycle. They're trading. The way that they trade is they erect and they build these blocks of flats and then they sell it. So those blocks of flats, not the blocks, the individual flats, the apartments, that is really the inventory of that company because they build it, they construct it with the intention to sell it as a profit. The mere fact that this company takes 3 years to actually complete such a block of flats means that it has an operating cycle that is longer than 1 year, right? It has, in this example that we are using, it's got a 3-year operating cycle. A similar situation with property developers that develop these cluster housing, where you've got cluster housing, you know, these what do they call it, townhouse complexes. It might take them 2 or 3 or 4 years to complete that complex, but the point is their intention is still to sell each little apartment, or in this case each little townhouse, separately to private residents, right? So the fact that it takes them 3 or 4 years to complete that townhouse development means that this kind of company has got a very long operating cycle. But those houses, those townhouses that they construct, that still constitutes their inventory, right? So it must still be disclosed as a current asset. Okay, and then the last one, number D, they say an entity shall classify an asset as current when the asset is cash or a cash equivalent. So that is the general rule, and we'll see there's one exception that we alluded to a little earlier. So in any situation where it is either cash, like we said, that is real banknotes and real coins, so like your petty cash or your cash float, or a cash equivalent, so that would be a bank account, like a cash savings account or check account, or even let's say a notice deposit or certain fixed deposits. So they will all be seen as cash and cash equivalents, and they will then be regarded as current assets. However, there is an exception, and this is the exception. They say unless unless indicates that is the exception. Unless the asset is restricted from being exchanged or used to settle a liability for at least 12 months after the reporting period. A mouthful, but it is actually pretty easy to summarize. It means if that cash or cash equivalent, well, cash is always immediately available, but if that cash equivalent is restricted in such a way that you cannot access it within 1 year after or 12 months after your reporting date, then it should not be seen as a current asset. Then it will not be classified as cash or cash equivalent. Then it will be seen, I'm not going to scroll all the way back up, but then it would rather be seen as a financial asset. And as we said earlier, a financial asset will then be part of your non-current assets. Okay, so let's type a few answers for me. I'm going to ask a few very simple questions quickly. So if you've got a current account, right, a check account, would that be cash and cash equivalent or financial assets? So if I refer to a financial asset, I mean it's non-current, and cash equivalent will be a current asset. So will that be under your current assets as cash and cash equivalents? You can just type yes or no for me, please. Yes or no? Can you access it within 12 months after the year end? Quite correct. Thank you. Thank you all. There's an Sinevuyo as well. Yes, it's a cash and cash equivalent. It's a current assets. Thank you, Naomi. Thank you, Sinevuyo. Quite correct. Yes, then it is because it is immediately accessible. The same applies to, let's say, a savings account where you can immediately access it. Now, let's maybe think of a few other examples. What about a 32-day notice deposit? What is a notice deposit? A notice deposit is where you have to give the bank where you have deposited the money. You've got to give them advance. You've got to give them notice that you are going to withdraw it. So if you want to withdraw the money from your notice deposit and it's a 32-day notice deposit, you will have to tell your bank, today I want to withdraw it, and then the money is only available in 32 days' time. So again, I'm going to ask you in that case, would that be part of cash and cash equivalents? If you can say yes for me, or would that be part of your financial assets, which is a non-current asset? For that, you can say no for me. No, yes, you don't need a question mark. It is yes. You're quite correct. Same with you, Sinevuyo. Yes, because you can still access it within 1 year after the financial year end. Going to make it a little bit more difficult every time. What about a 6-month fixed deposit? If you have a 6 months fixed deposit, it means you deposit it now. You can only access it in 6 months. So let's say your financial year ends on the 31st of December of a particular year, and you do a 6 months fixed deposit. Would that be part of cash and cash equivalents, a current asset? Yes. Or will it be part of your financial assets under non-current assets? That we will then say no. Now we've got a difference of opinion. Kubile says no, Sinevuyo says yes. The answer here, it is still a current asset because you can still access it within 1 year after your financial year end. Right. But now let's have a look at a more difficult one. It's actually not more difficult. I think it's quite obvious. Let's say you have got a 24-month fixed deposit. A 24 months fixed deposit. So you make a deposit at the bank. That is normally to get a higher interest rate. The longer you fix it, the better interest rate you can get. So you've got a 2-year or 24 months fixed deposit. Will that then be a current asset under cash and cash equivalents? That will be a yes answer. Or will it be, there we go already. Thank you, Sinevuyo. You are very quick. Then it's going to be non-current. Thank Naomi. Yes, then you are all correct. Then it's going to be a non-current asset because you cannot access that money in that particular bank account within 1 year after the financial year ends. Right, so you're correct. So that is what is defined as a current asset. Then, ladies and gentlemen, one of the easiest definitions, there's actually two very easy definitions in financial accounting. Now we're going to cover one of the two easiest definitions you'll ever encounter in financial accounting, and that is the definition of a non-current asset. How is a non-current asset defined? They say a non-current asset is any asset that is not a current asset. Okay, right, so that is very simple. They say an entity shall classify all other assets as non-current. So you can basically, in effect, say that the definition of a non-current asset is an asset that is not a current asset. So as soon as an asset doesn't qualify as current in terms of those four components of a current definition, then it means it is non-current, right? Let's maybe just pause there before we go to liabilities. Any questions from your side? No questions? Okay. The definition of current liabilities, it is very similar to that of a current asset. So let's just have a look there. When is a liability seen as current? They say an entity shall classify a liability as current. Let's again maybe look at the easiest one first. That is again C. When the liability is due to be settled within 12 months after the reporting period. So if your intention is to settle or pay that liability within a year after your financial year ends, then it means it is going to be disclosed as a current liability, right? So again, if your financial year ends on the 31st of December 2019, and your intention, like with ordinary creditors, your intention is to pay that debt to them before the 31st of December 2020, it means it is a current liability, right? So that is the easy one. Then again, let's have a look at B. They say if the liability is primarily for the purpose of trading. Now, I don't want to make a long story of this, but you may be surprised to know that one is able to not only trade in assets, you can also trade in liabilities. You know that we've spoken about debentures in last semester. A debenture is a loan instrument as opposed to an equity instrument. And companies or other entities can actually trade in debentures. So a debenture is still a liability, but you can trade in that. So if your main purpose is not to hold that liability in order to generate interest income from it, but rather to make a profit from the buying and selling of those debentures or bonds for that matter, any kind of liability or debt instrument, then it is seen as a current liability. Then A, that goes hand in hand with what we've discussed under assets as well. So an entity shall classify a liability as current when it expects to settle the liability in its normal operating cycle. So there again, I think the best example that we can use is the construction or the property development market. If that company that is going to develop, let's say, the block of flats, it's going to take them 3 years to actually complete that skyscraper block of flats, but the intention is still to sell those blocks of flats for profit purposes. In other words, it's their inventory, and at the same time they need financing in order to fund the construction of that block of flats. It means they will then have to enter into some sort of loan agreement with a bank, right? So they will go to the bank and they will say, this is going to be a loan that we are going to pay over 3 years. But in this case, because this company has a normal operating cycle that is 3 years, this needs to be basically matched with their inventory. So the blocks of flats will be inventory for them, so it'll be a current asset, and at the same time, this liability, even though it is repayable over a 3-year period, will actually be seen as a current liability, right? Simply because this company has got a very long operating cycle. So it's almost a little matching exercise, because the asset that takes them 3 years to be or the inventory, I should say, which is an asset, which takes them 3 years to sell, is matched with the liability that they're also going to take 3 years to pay, but it is part of this 3-year normal operating cycle of this kind of business, right? So from the day they start constructing the block of flats until they have been able to sell all of those individual flats or apartments as part of their inventory, that takes them 3 years. That means that is their normal operating cycle. So a liability that has been taken out to fund the construction of that block of flats or that townhouse development for that matter will in that case also be seen as a current liability, right? Then just number D, an entity shall classify liability as current when it does not have an unconditional right to defer settlement of the liability for at least 12 months after the reporting period. That's quite a mouthful, but basically what it means, if the company has the ability, and there's no conditions to attach to it, if they have the ability to defer the settlement for longer than a year after the financial year end, then it should be seen as a non-current liability. Defer simply means to postpone it, right? So if they are able to postpone, unconditionally, they are able to postpone the repayment or settlement of a liability for more than a year after the financial year end, it should be seen as a non-current liability. But if the company has got no power to defer or to delay the settlement beyond a year after the financial year end, then it is almost the same as situation C, where it must then be seen as a current liability. And then the second of the easiest definitions you'll ever find in financial accounting, what is the definition of a non-current liability? The definition of a non-current liability is basically any liability that cannot be classified as a current liability, right? So an entity shall classify all other liabilities as non-current. So you can effectively say the definition of a non-current asset is non-current liability is any liability that does not qualify to be a current liability in terms of those four components of the definition of a current liability. Okay, so let's maybe just check whether there are any questions, ladies and gentlemen. Naomi asked here a question: what is the point of trading debentures? Phew, Naomi, it's quite a long story, and I'm going to keep it as short as possible. What is the point of trading debentures or any other liabilities such as bonds? It all has to do with interest rates, with interest rates and fluctuating interest rates. Like I said, I don't want to take too much time, but I also want you to understand. So if you're a debenture or a bond holder, in other words, if a company issues those loan instruments, debentures to you, and you are one of those people that take it up, that debenture or that bond has got a fixed interest rate, right? So when the company issues the debenture, they say it is 12% debentures, as you know, right? So there's an interest rate that is attached to it. So what happens in the market, a company or a person or an institution can take up those debentures, and then they know for the next 5 or 10 or how, depending on the period of the debentures, they are going to get a fixed interest rate of 12%, right? Now remember, you have taken up the debentures at a fixed price of, let's say, they are 10,000 rands debentures, right? You remember there's a fixed issue price which they must repay you, and then there's also the interest rate. So now let's say we are in a process where interest rates are decreasing. So suddenly in the market, interest rates are going down. So on any other kind of investment, you are now getting 1 or 2 or 3% less interest. But on the debentures, it's still 12%. So now you may find that other institutions who want to derive income from interest in debentures, they would like to buy those debentures from you. And even though the issue price might have been 10,000 rands, they might now say, I am prepared to pay you 10,500 rand to take that debenture over, because I'm going to for another 5 or 6 or 10 years, and I'm going to generate a higher interest income from that. Right. So that means there is actually an active trading market in debentures or bonds. Does that make sense, Naomi? No. Does that answer your question? So those debentures, even though a company owns it, it is still actually a loan instrument, does it? Thank you, Naomi. So you may find that because it's got a fixed interest rate and market interest rates are decreasing, coming down, there might be other institutes or institutions that are interested in generating interest income, and then they can get a much higher interest income from being the debenture holders than just simply having a fixed deposit in the bank, right? So there is actually an active market in liabilities as well. Any other questions? Okay, then when it comes to the notes, we're going to talk about the notes later on. We can just see there is a paragraph that deals with what can be disclosed either in the statement itself or the notes. Normally, we're just going to describe the aggregate of a specific category of non-current assets, such as property, plant, and equipment on the face of our statement, and then any other additional information we are going to show in the notes. So if we take property, plant, and equipment as an example again, in the case of property, plant, and equipment, we are going to disaggregate it. You remember yesterday we spoke about materiality and aggregation, and we said the opposite of aggregation is either disaggregation or segregation. So in the note, we are going to take that one figure, the one figure that we show on the face of our statement of financial position for property, plant, and equipment, and we're going to disaggregate it. So we're going to break it down into its components. So there we are going to say, what classes does it consist of? Does it consist of, let's say, plant with X carrying amount, and it consists of property with Y carrying amount, and it consists of motor vehicles with Z carrying amount. So there we are going to provide further information with regards to property, plant, and equipment. That additional information we're going to be discussing a little bit later when we talk about the notes, and also obviously when we do IAS 16 next term. So your more information about those items that we have in the on the face of the statement of financial position will then be disclosed in the notes. I just want us to have a look at paragraph 29 as well. You already know this when we did share capital last term. You know that we had a share capital note. So what must be disclosed in the share capital note? It comes from IAS 1. I know it also comes from the IAS that deals with share capital, but here in IAS 1 they already tell us a few things. We can just perhaps look at A1, 3, and 4. Those are the ones that you know. So they say for each class of share capital, what is a class of share capital? Something like ordinary share capital or preference share capital. So for each of them, we must have a note. And what must be disclosed in that note? Quite a number of things, but the things we know about at this stage already is the number of shares authorized. And again, you'll remember from that note, now we're not talking about the value of the shares, we're talking about the number of shares. You already did that note last term. So we must go and describe the number of shares authorized. We can just skip 2 for the time being, fully paid up and issued. That is a matter that we'll still discuss. Also, what we must disclose is the par value per share, right? And we know that companies now, since the 2008 Companies Act came into effect, they cannot issue par value shares in South Africa anymore. But remember, IAS 1 is an international document. There are many other countries that can still issue par value shares. So if they issue par value shares, the par value must be disclosed. But also they go further. If you issue non-par value shares, right? If the shares have no par value, you must disclose the fact that the shares have no par value. Now you know why it's so important that when we described the authorized share capital, we said ordinary shares of no par value, right? It's a requirement of IAS 1. You must either disclose the par value, or if the shares have no par value, then you must disclose the fact that those shares have no par value. The other one that we already know about, you've already done that last term when we did share capital. In that note, the share capital note, we must provide a reconciliation of the number of shares outstanding, that also referred to as the number of shares in issue at the beginning and at the end of the period. So that is why we had that note where, besides disclosing the authorized number of shares of no par value, we also said the outstanding shares, what was the balance outstanding at the beginning of the period, what was the balance outstanding at the end of the period, and what are the reconciling items, such as a share buyback or an issue of shares or a redemption of preference shares, right? So this is where the requirement comes from. I think that is all that I wanted to mention with regards to the statement of financial position. Now that we know, now that we have got all that information, next week we're going to draw up a statement of financial position as well as all these other financial statements, but now in terms of IAS 1. So we're going to show, like we did in Financial Accounting 1, we're not going to show property, plant, equipment, and then also the cost and also the accumulated depreciation on the face of the statement. We're only going to show the carrying amount. And then any further information will be described in the notes to the statement of financial position. Okay, any questions on the statement of financial position at this stage? Let's maybe just pause there for a few seconds. You can either raise your hand, ask the question, or you can type it. No questions from your side? Okay, so then we're all on the same page. Right, so when it comes to the statement of profit and loss and other comprehensive income, there we must perhaps just understand that IAS 1 does allow us a one-statement approach or a two-statement approach. In the case of the two-statement approach, that will normally be followed by a company where the company has got many categories of other comprehensive income. You remember yesterday we said there was a list, I think it was 10 of them, it went from A to J, of all the possibilities of other comprehensive income. So if this company has got 7 or 8 categories of other comprehensive income, then it'll make sense for them to follow the two-statement approach. So then they'll have one statement, which they call the statement of profit or loss, that ends with a profit for the year, and then they'll have a second statement, which they will then call the statement of total other comprehensive income, the statement of other comprehensive income, which will then start with a profit or loss that they carry forward from the statement of profit or loss, and then describe all the items of other comprehensive income. And then at the end of that statement, you'll have total comprehensive income for that financial accounting period, which will then be transferred to your statement of changes in equity. If the company, however, only has one or two, maybe at the most, categories of other comprehensive income, then it means you can still fit it all into onto one page, right? The idea is we want to show each statement on one page. The statement of financial position, statement of profit or loss, and other comprehensive income, statement of changes in equity. We want to show it all on one page so that the reader or the user of the financial statements can summarize it at a glance. So like I say, if the company only has one or two items of other comprehensive income, then you will follow the one statement approach. In fact, in financial accounting too, we are going to be following the one statement approach. So if we have one statement, it means that statement we are going to call our statement of comprehensive income, and it will consist of two sections. The first section will then be what we call our profit or loss section, which will start with revenue. I'm going to give you a whole structure and layout of this statement very soon. So it'll start with revenue and it'll end with your profit or loss for the year. And then you'll have a subheading called other comprehensive income, and then you list your one or two items of other comprehensive income below that. And then you arrive at the total comprehensive income for that financial year. Now, there's quite a long list here of what needs to be disclosed. I'm going to rather provide you with a little structure. So I'm going to provide you with a structure. We can see all sorts of things like tax expense and so forth that need to be disclosed. So what I'm going to do, I'm going to now type for you the structure of how we are going to design our statement of comprehensive income. I want us to follow this structure. This is the structure that is followed in practice as well. So this is truly, really what companies do. They follow this particular structure. Now, we're always going to start our statement of comprehensive income with an item called revenue. Right? An item called revenue. The reason why we're starting with revenue is a disclosable item. In fact, everything that we are going to be talking about now will be disclosable items. What is meant by the term disclosable item? It means in terms of the International Financial Reporting Standards, you have to show it on the face of a particular financial statement. Ladies and gentlemen, so before we look at the structure of this statement of comprehensive income, I need you to take a few notes here. We first of all have to understand what is meant by revenue. Now, there is a different IAS, I think it's IAS 18. I won't bet my house on that, but I think it's IAS 18 that is titled revenue. And it defines revenue as coming from one or all five, any number of 5 sources. Can you perhaps just start for me? Can you see my whiteboard? If somebody can just start me, yes or no? Yes, okay, thank you so much. So you can see my whiteboard. So the categories of revenue, and if you can please make a note of this because we have to know this, but it's not in your textbook. The textbook doesn't deal with the IAS that covers revenue, but we have to know this. So revenue what does revenue consist of? Revenue can come from one of 5 sources. So revenue can come from, then we've got 5 of them. Sales of goods, so revenue from sales of goods. The second possibility is revenue from services rendered. Right, so we've got revenue from sales of goods, revenue from services rendered. Another possibility is revenue from interest income. The revenue from interest income. A fourth possibility is revenue from dividend income. Revenue from dividend income. And then the fifth possibility that is mentioned in that IAS is revenue from royalties income. Revenue from royalties income, right? So those are the 5 categories of that is classified as revenue. If the income is, let's say, for instance, a profit on disposal of a non-current asset, that is not seen as revenue. That is then seen as other income. So the only items that form part of revenue would be revenue from the sale of goods, in the case of a trading entity, revenue from services rendered, such as the services provided by a hairdresser, let's say, revenue from interest income, so that could be the interest you earn on debentures that you hold, or the interest that you earn on your bank accounts, or even the interest that you charge to your debtors who pay late. Dividend income, revenue from dividend income, that is if you hold shares in another company, when they declare the dividends, you receive it as income. That is part of your revenue. And then royalties income. What is royalties income? Royalties income is where you have some sort of intellectual property and you derive income from that. What is an intellectual property? Well, you know, the body where you have to register your company at is called the CIPC, isn't that? CIPC. What does CIPC stand for? The Companies and Intellectual Properties Commission. So what is intellectual properties? It means that the name of that body means you can register companies there, but you can also register intellectual property there. So that will be something like a copyright or a patent. What is a typical copyright? If you have a book, if you have a textbook, you've got Gripping Garp as a textbook, right? The owner of that intellectual property is Professor Catherine Service. She wrote the book. She wrote the book many moons ago, and she's been updating it every year. So she has got copyright over that book. So you can't just take the book and copy all 1,500 pages of it. Then you are transgressing her right to generate income from her intellectual property. So that is typically a copyright. That is an intellectual property. So if you have such intellectual property registered at the CIPC, you can generate income from that, and that is royalties income. The same with, I know I'm just saying this to entertain you, the same with, let's say, singer-songwriters. If Rihanna writes a song and she sings a song and she brings out a CD, how does she make money from that song? Does she stand on the corner and sell her CDs herself? No. But for every CD that has a song that she wrote on it, and that CD gets sold, let's say for 100 rands, she may get 50 cents out of that. So she gets royalties income because she wrote the song, and that song is her intellectual property. I always wonder what must Paul McCartney's royalties income be, because he's the person who's written the most songs in history. I don't know how many thousand songs he's written, but anyway, and they are all played at, sports stadiums, Hey Jude and things like that. Okay, so that is what revenue consists of. Now I want us to go and discuss the structure of our statement of comprehensive income. So we're going to start with revenue. But that is our first item. We're going to start with revenue. After revenue, we are going to disclose, and remember, revenue then includes those 5 categories that we've just mentioned, right? Revenue from sales of goods, or interest income, dividend income, and so forth. Then if we have any other kind of income that we have realized, remember, this must be realized, otherwise it cannot be part of your profit or loss. If we've got any other kind of income that we have realized, but that does not form part of revenue, then we disclose the total of those kinds of income and we simply call it other income. Then we call it other income. We're not going to disclose what it consists of. We have got a very special little note which we will discuss later on. It's called our profit before tax note. So there you can make a note of the name, a note of the name of the note, if you know what I mean. The note is going to be called your profit before tax note, where you will then disclose the nature of the items that are included in other income. By the way, a similar principle applies to revenue. If you've only got one category of revenue, let's say you've only got revenue from sales, then you don't need a revenue note. Then you can simply call the first line of this statement, you can call revenue from sales. Or if you're a hairdresser and you do not sell shampoos, you only perform hairdressing services, and your only revenue is from services rendered, then you don't need a revenue note. Then you can just call your first item revenue from services rendered. But if you've got revenue from more than one source, again, remember, we don't want to clutter up. We don't want to clutter up this statement. We want the users of the statement to interpret the performance of this company at a glance. Then you'll have to have a revenue note. So then we'll have a different note that we call our revenue note, and there we will disclose that revenue, that one that we've got there, that's got one figure. It consists of revenue from sales, sales of goods, X rands, revenue from services rendered, Y rands, revenue from royalties income, Z rands, and so forth. And the total of that revenue note will then add up to the amount you disclose as revenue. Okay, so we've got revenue, whatever qualifies as revenue, then other income. Then, ladies and gentlemen, we're going to talk about the function method and the nature method of drawing up a statement of comprehensive income soon. But first of all, I would want us to do this structure simply because I have got this whiteboard in front of us now. This is according to the function method. We're going to discuss a little bit later on what is the difference between the function method and the nature method. So according to the function method, which is appropriate for big companies, we now are going to disclose our various cost functions. The first one that we disclose, the first cost function, is the one that has to do with our inventories. And that cost we call our cost of sales. Right, so then we're going to have cost of sales. That's our first cost function. If this is a trading company, if it's a services company, clearly then it won't have a cost of sales. Then it all depends on how this company is structured. What are their core functions? So the accountant, the chief accountant, and the financial director of this company, they will come together. They will say, what are our core functions? Different companies will have different core functions. So let's maybe just mention a few very common ones. Most companies will have an administrative function, right? The administration, that includes your secretaries, your CEO, and they need desks, and they need chairs, and they need printers, and they need computers. So any kind of expense that is related to this specific function that deals with the administration of the company will then be allocated to a specific cost function, which we can then call administrative cost. Let me just see if I'm typing correctly. Administrative cost. So all your expenses that deal with the administration of the company will then be allocated to administrative cost. Now, you may ask here, why in large companies do we use this method? You must remember, in a small company, you might have 7 or 8 or 10 kinds of expenses. So it's very easy to then go and show them by virtue of their nature, because there are only 10 of them, it still fits on one page. But if you have a large company and they might have 50 different types of expenses, then it is going to be very hard to show all 50 kinds of expenses on one page, and people can still read it without a magnifying glass. Right, it must still be readable. Okay, so therefore you have to combine or aggregate. Here we come back to that little beautiful little word of aggregation. There you have to combine certain expenses. You combine them logically by attaching them to a specific cost function, such as administration. Another one might be with the distribution of your goods. If you're a trader, you might have certain expenses like the depreciation on your delivery vehicles, or the salaries of your delivery staff, or the fuel and services that you need to be able to run those delivery vehicles. They all have to do with the distribution of your product. So then you will identify this as a core function of this company, and you can call that then, let's say, distribution. Distribution function, you allocate those expenses that relate to distribution to a cost function, which we then call distribution cost. Right, and like I said, the financial director and the chief accountant will have to go and decide what are the core functions of this company. There could be, let's say, a marketing function that is very important. Let's maybe type that as well. Perhaps a marketing function, then all your marketing costs will be included there. There might be other kinds of operating costs. So you might have as part of your core operations, your operating costs, and so forth. Okay, so once you've allocated all the costs to the various cost functions, then, ladies and gentlemen, there is one little exception to the rule. Actually, two. There are two exceptions to the rule. Sorry, make that two. The two exceptions, and it comes from IAS 1, states that your finance cost should not be allocated to any cost function. Your finance cost must be disclosed separately. Also, IAS 1, we saw it briefly a little while ago when I scrolled down. It also states that your taxation expense, your income tax expense, must be disclosed separately. It should not be allocated to a cost function. The reason for that, ladies and gentlemen, is to make the analysis of your financial statements easy. If somebody wants to analyze the financial statements, very often you find that the finance cost might be varying vastly from the one year to the next. So very often when people work out ratio analysis, when they calculate ratios, they would rather exclude the financing cost in certain circumstances. The same with your income tax expense. You know that the effective tax rate might be vastly different from the applicable tax rate. So your income tax expense may also distort certain figures from the one year to the next. So when certain analysts want to do ratio analysis and other kinds of financial analysis of your financial statements, they may want to exclude the income tax expense for it. So for that purpose, IAS 1 specifies that your finance cost and your income tax expense must be disclosed separately. Right. So once we've disclosed all our cost functions, the last one that we are then going to disclose is our finance cost separately. Right. Then, ladies and gentlemen, we're going to have a little subtotal here. Oh, that's not a very straight line. Use your imagination and imagine that is a straight line. Then we're going to have a little subtotal there. Just go to the text again. That subtotal we will give a name, and that is our revenue plus our other income, less our various cost functions, less the finance cost, but before we actually disclose the income tax expense. So we're going to give that a name. We're going to call that our profit before tax, right? We call that our profit before tax. After that, Let me just read here. Vavi has written, if the company had petty cash, would it be regarded as a finance cost or otherwise? Vavi, no. If the company had petty cash, it's not an expense. Remember, that is cash. Petty cash is cash that is physically sitting in the cash box in the company's uh, office or in a register, cash register. So therefore, it's what is that? If it's cash, it's let's say what element is it first? If it's petty cash, if the company had petty cash, what kind of element would that be? Would it be an expense? Remember, the only thing that can be a finance cost if it is an expense. In other words, it must be something like an interest expense. So is petty cash an expense, or what element is it? If somebody can type for us, what kind of an element is petty cash? It's an asset. Thank you, Bradley Biswapi, and thank you for thanking me yesterday. I appreciate that. Thank you. So yes, remember, thank you, Sinavuyo. Yes, it's a current asset. I'm going to ask you why it is a current asset just now. But Vavi, like Bradley said, like Sinavuyo said, remember petty cash is an asset. It is not an expense. So therefore, if it's not an expense, it cannot be allocated to a cost function. You can only allocate various expenses to a cost function. Petty cash is an asset, and like Bradley said, it's an asset. Like Sinavuyo said, it's a current asset. Why is it a current asset? Because it is a cash or cash equivalent. In this case, it's not a cash equivalent. It is really, truly physical cash, right? So therefore, it falls in the under the definition of a current asset. Pleasure, Bobby. Okay, so profit before tax. Now, if we say something profit before tax, then you all know what comes next. So next comes tax. Okay, but don't just write tax, ladies and gentlemen. We write there the income tax expense. Income tax expense. If you still encounter old text, you may find that a number of years ago they would have said normal tax expense. Normal tax was a term referred to in the old days when companies were subject to more kinds of taxes than income tax. Companies were subject to, for instance, what we refer to as STC, secondary tax on companies. That would have been included there. But STC has fallen away. It has been replaced by dividends tax, right? And as you know from last term, dividends tax is not a tax on the company. So it's not a cost to the company. It's a cost for the shareholders. So the shareholder, the dividend tax is levied on the shareholder. So the only kind of tax that is levied on the company is the income tax. The reason why the word expense is important for us there is to distinguish it from, let's say, for instance, pay a bill, which indicates not an expense, it indicates a liability. And then when we get to term 4, when we do our statement of cash flows, we'll also see there's an item in the statement of cash flows that is called income tax paid. And income tax paid is not the same as income tax payable, because that's a liability. And income tax paid is also not the same as the income tax expense. As you remember from last term, the income tax expense has been accrued. It is an estimate that we make at the end of the financial year. Whereas the income tax paid, which we find in our statement of cash flows, is the sum of the monies that you've paid to the revenue service, such as your first provisional tax payment, plus your second provisional tax payment, plus any top-up payment. So we must distinguish between an expense on the one hand, a payable, which is a liability on the other hand, a paid, which indicates a cash flow, right? A cash flow is not the same as an expense. Okay, income tax expense. Now I'm going to draw a slightly straighter line. We're going to have a line there that's a little bit better because we're going to have another subtotal. What are we going to call that subtotal? Again, it is a name that is used in IAS 2, so we cannot use a different description. We cannot say it's now profit after tax because IAS 1, what is the term that it used? IAS 1 uses the term profit for the year or profit for the period if it's not a full year. So let's type there profit for the year. I'm just going to say slash period. So if it's not a full year, then you're not going to say profit for the year, then you're going to say profit for the period. Okay, so there we've got another subtotal, that is then the profit for the year. So that profit is the profit that has been realized either through revenue, less your various expenses, which are all allocated into the cost functions, less your finance cost, less your income tax expense. But now, as we've seen yesterday, there are certain categories which are regarded as so-called other comprehensive income, such as, for instance, an increase in the value of a non-current asset such as property, or an increase in the value of the investments that you have in shares, but you haven't sold the property yet, so you cannot include that in your profit for the year. Or you haven't sold the shares yet, so you cannot include that in the profit for the year. However, the value of that share investment or the value of your investment in property has increased, so therefore you have to have a corresponding credit. And that is what we refer to as the other comprehensive income, which will then be increasing your equity for the year, but it doesn't increase your retained earnings for the year. You'll have a separate column for each type of other comprehensive income in your statement of changes in equity. So whatever increases the other comprehensive income will be shown in its own little column in your statement of changes in equity. It does not affect your retained earnings, right? So here we are going to give ourselves a subheading. Subheading, remember that first part, if we are using the one statement approach, that first part is what we now refer to as our profit or loss section. The profit or loss section. If we had been using the two statement approach, then this would be the one whole statement, the statement that we call our statement of profit or loss, right? So if we are using a two statement approach, we'll call this our statement of profit or loss. This is where it will end. Then we'll have a separate statement called our statement of other comprehensive income. But we are using the one statement approach. So this is just the first section. So now we're going to give a subheading to the next section. So the next section is then called other comprehensive income. Other comprehensive income, right? Other comprehensive income, and then we are going to disclose at the bottom there what the categories of other comprehensive income are. However, there are paragraphs, we're not going to read through all of them. There are certain paragraphs in IAS 1 that describes to us what must be disclosed. One of the things that we need to disclose is we must disclose whether that, before we even describe the nature of the other comprehensive income, before we describe that, we must also describe whether it can, whether it is allowed, whether it may be reclassified to profit or loss in the future or not. We've seen yesterday that something like an increase in a revaluation reserve is not allowed to be reclassified to profit and loss. Whereas something like a gain on an investment, if you should actually sell that investment afterwards, you can reclassify that gain to a profit. In other words, once you realize the gain, you can then take it out of other comprehensive income and then add it into your other income at the top there, just below revenue, which means then you do recognize it in your profit for that year, but you take it out of other comprehensive income. But that only happens when you actually realize it. That kind of adjustment is called a reclassification adjustment. So I'm now going to, we must now imagine that this carries on there at the bottom. Okay, so this is not a new statement, it carries on at the bottom. So now we're going to describe whether that specific item may or may not be reclassified to profit or loss. So let's maybe start with one that may not. So we're going to describe the item that may not be reclassified to profit or loss, and a colon. I wonder if you can see all of that. It is sort of out of range of my black, let me see if I can move that. Doesn't look like I can move it. Anyway, if it is out of your view there, what it states there is item that may not be reclassified to profit or loss. Okay, I'm off my whiteboard here. So item that may not be reclassified to profit and loss, colon, and then we describe the nature of it. Let's say increase in revaluation reserve. And then IAS1 goes further and it says we must also tell the user whether this includes tax, if the tax had already been deducted, in which case we must then put in brackets net of tax, or if the tax on that increase has not been deducted yet, then you must deduct it afterwards. But in the case of an increase in a revaluation reserve, it actually has no effect on your tax, right? It is simply an increase in an asset, property that hasn't been realized yet, so there is no tax effect. So you can just write in brackets there, no tax effect. I'm going off the page there again. My apologies for that. I'm going to start a little bit more to the left now, but here I've got a little bit of a fat tummy, so I might have to start towards the right again. Then we go to, let's say, another category there, an item that may be reclassified to profit or loss. So we're going to give it a subheading again, item that may be reclassified to profit or loss, colon. Let me see if I can fit in there, and there it could, let's say, a gain on, let's just call it a gain on investment. That will, because you haven't realized it, it will have no tax effect. Okay, so now you have disclosed, first of all, under your other comprehensive income, you have disclosed the fact that this item may not be reclassified in the future to profit and loss. You've also disclosed the nature of the item and that it has no tax effect. In the next one here, the gain on investment, you've disclosed the fact that the item may in the future be classified to profit or loss, but only once you have realized it. Here you've disclosed the nature of that item, a gain on investment, and in this case, it also has no tax effect. Then you are again going to draw a line to show that you are going to provide a total or a subtotal. In this case, it is actually now a total, right? It is a total. This is the end of the statement. So you've got a single line above that total and a double line below it, right? And what are we going to call that total? That total is going to have a specific name. The name is actually a disclosable item in our IAS 1, in International Accounting Standard 1. They say that needs to be described as total comprehensive income. Right, that is how we must describe that, total comprehensive income. So that is the structure, ladies and gentlemen, of our statement of comprehensive income. Hopefully you've all made a note of that. If you haven't, then you'll have to go and well, it is in your textbook as well. So you'll find it in chapter 3 of your textbook. So let's just pause there and ask, are there any questions from your side? No hands up, no questions in the text box. Okay. So let's go back to IAS 1 then, if you have no further questions there. Where were we with IAS 1? Now we can, we've had a look at our statement of financial position. We've had a look at our statement of comprehensive income. Just a story that I want to talk about, the nature method and the function method. There we've got a structure, by the way. Where is that? That is on page 30 of the IAS 1. So there we've got a typical structure as well. I just want to, that is a structure for the nature method, by the way, the nature method, and the next one for the function method. So what is meant by the nature method? The nature method, you are describing the nature of the expense. So for instance, if you pay salaries and you pay wages and you pay the company contributions to your staff's medical aid, and you're paying a contribution to their pension fund and so forth, then you describe the nature. That is all employee benefits expense. Or if you've got a depreciation expense, you describe the nature. Or if you've got amortization expense, which we'll discuss next quarter, next you describe it by virtue of its nature. But like we said, this is appropriate for a smaller kind of entity that only has maybe 7 or 10 types of expenses. But as soon as you've got a large entity, a big company that has got maybe 50 or 55 different kinds of expenses, and you cannot show all of them on one page, then it is more appropriate to use the function method. So then you are going to allocate all your different expenses to those cost functions that we've mentioned earlier. And here we've got an indication of that. If you're using the cost function, you're going to start with revenue. If there are any other income, you're going to include it there. Gross profit, you don't have to disclose it. They mention it here as an example, but it's not actually a disclosable item. They show other income here, whereas I believe it's better to do it after revenue. So this is just an example. So before we get to the statement of changes in equity, let's just ask again, you understand now the difference between the function and the nature method. Nature method, you're going to disclose the actual expense, such as depreciation or employee benefits or water and electricity or printing and stationery, whereas in the case of the function method, you're going to allocate that expenses to a core function of the company. So let's maybe just check, are there any questions from your side? You can raise your hand. You can type it in the chat box. Just one last thing that I've got to mention when it comes to the function method, and this deals with materiality. Now, you all know from Tuesday's discussion as well as yesterday's discussion what is meant by materiality. It is an item that can influence the economic decision of the user of the financial statement. So if you are using the function method where you have allocated the expenses to a cost function, and you believe that specific kind of expense to be material, either in value or in nature, then you still have to go and disclose it. But then you do not disclose it on the face of your statement of comprehensive income. You then design a separate note. And that note we are going to call our profit before tax note, because it summarizes various expenses that is already included in your figure that we describe as profit before tax, but that has sort of disappeared off the face of your statement of comprehensive income because you are using the function method. Then you're going to disclose that in your profit before tax note. So there you're going to say included, well, you just say included in the profit before tax are the following items. For instance, depreciation and employee benefits expense, write down of inventories and so forth, right? And its amounts. In fact, there is a paragraph that I wanted us to have a look at. Let me just go back. Which one was it? 90 something. 91 was it? Let me just have a look. No, that we've done. 92. Okay, we've done reclassification, then it must be 99. Sorry for that. There we go. 99. Paragraph 99, they say an entity shall present an analysis of expenses recognized in profit or loss under a classification based on either their nature or their function within the entity, which provides information that is reliable and more relevant. So it means we can either use the nature method, but that is only appropriate in smaller enterprises, or their function method that is more appropriate for larger entities. Then I also wanted to make mention of paragraph 104. Let me just see what that was. That might be the profit before tax note. There they say, okay, so there, if you can make a note of paragraph 104, an entity classifying expenses by their function. In other words, if you are going to use the function method and you are allocating your expenses to cost functions, then you shall disclose additional information on the nature of expenses. And then they mention a few examples such as depreciation, because that is seen as a material item, perhaps not in amount, but in nature. Amortization expense, employee benefits expense. But then if you are using the function method, you're not going to show the nature on the face of your statement of comprehensive income. That, if you can make a note, ladies and gentlemen, that is where your profit before tax note comes in, right? So you're going to then disclose additional information on the nature of those expenses that you regard as being material. So it's significant enough, either in nature or in amount, that you believe it must be disclosed to the users of the financial statements. It could influence their economic decision making. Okay, that's all I wanted to say about the statement of comprehensive income. So next week we are going to put all of this in action. So we are going to draft the financial statements using all of this information and all of these principles. Statement of changes in equity. I'm pretty sure you are very well versed in that. For the very first time in my life this year, I've been presenting Financial Accounting 1 as well, and I see that the statement of changes in equity is covered pretty well. But just for the sake of completeness, paragraph 106, they say an entity shall present a statement of changes in equity. And what will it consist of? It will consist of total comprehensive income for the period, showing separately the total amounts attributable to owners of the parent. Don't worry about that. And to non-controlling interest, don't worry about that. That deals with group structures. We are not dealing with a group structure yet. And then for each component of equity, the effects of retrospective application. We do not need to worry about this restatement yet. We're going to do that in Financial Accounting 3. So what we need to know is this, that reconciliation from your opening to closing balances will include the profit and loss. So that will be added to your, perhaps you can type for me there. The amount for the profit and loss. To which column in your statement of changes in equity will the amount of profit and loss go to? Just type for me, please, in the chat box. To which column in your statement of changes in equity? The profit or loss. Which column? What is that column's heading? Retained income, retained earnings. Thank you, Sinivuyu. Right, so your retained income or your retained earnings column, that is where the profit and loss goes. Molatisi Milani, you've got your hand up. Yes, would you like to ask something? Just remember to switch on your microphone.
Hi, sir. Can I ask when we end the lesson, because it goes back to the function method on the other comprehensive income. I've got two questions on the two statements made there.
Okay, would you like to ask them now, or do you want to wait until the end of the class?
I can wait till the end of the class, sir.
Okay, whatever suits you better, but then Molatisi, please then raise your hand again, because I'm almost certain I'm going to forget about this. Okay, so at the end of the class, when we start winding down, just raise your hand again and then ask that, then we'll discuss it. Please remind me.
Okay, sir.
Thank you. Sinavuyu, yes, so that will go to the retained earnings column. Then, like we said, for each and every kind of other comprehensive income, such as a gain on investment or a revaluation reserve, those are the two that we deal with in financial accounting too. You will have a column for each one of them, right? So any kind of other comprehensive income. So if you have an increase in a revaluation reserve, it'll have its own column in your statement of changes in equity. Or if you've got a gain on investments, it'll have its own column in your statement of changes in equity. And then thirdly, any transactions with owners in their capacity as owners, showing separately contributions by and contributions to owners and changes in ownership interests and subsidiaries. Do not worry about subsidiaries. That again deals with a group structure. So that means effectively, ladies and gentlemen, that for each class of shares, we will also need a column. So if we have got ordinary shares, then we'll have a column called ordinary share capital. And then transactions with our owners, such as the issue of new shares, will be included in that column. If you have a buyback of ordinary shares or a redemption of preference shares, it will be indicated under that class of shares. But do not forget, when it comes to a distribution, a dividend, that does not decrease or increase your share capital. A distribution is always a distribution of retained earnings. So if you have an ordinary dividend declared or a preference dividend declared, that will decrease not the ordinary share capital and not the preference share capital. It will decrease your retained earnings. I'm just wondering, maybe what we are going to do now, next we're going to look at the notes, the statement of cash flows. Remember the statement of cash flows? We are going to do that in the fourth term, the last term of the year. That is a separate international accounting standard. The statement of cash flows is not subject to the stipulations of IAS 1. It's got its own little international accounting standard, IAS number 7. So the last part we need to look at when it comes to IAS 1 is the part about the notes. So before we do that, before we step away from the statement of comprehensive income, let us ask you to, Sinavuyu, was it Who was it again? Wasn't Sinawiyu? Just ask your questions again about the statement of comprehensive income. I think it was Barbie. No, it was Molatisi Milani. There we go. Yes, Molatisi Milani, if you can just ask those two questions, let us deal with them, and then we can go to the notes. Just give one question
So
at a time.
I more want for clarity, sir. There are those two statements made under the comprehensive income, where one says item that may not be reclassified, and then the second last statement which says item that may be classified to profit and loss. If you can go back to it, sir, and kind of explain more into it, because I'm kind of confused.
Okay. Okay, unfortunately, I haven't got that on my whiteboard anymore. I've deleted the whiteboard or erased the whiteboard, but I know I think everybody knows what you're talking about. Let me maybe just go back to what we said yesterday. Yesterday we had a look at I think it was 10 different possibilities when it comes to other comprehensive income. And we must realize that all of them deal with gains or losses that have not been realized. In other words, the asset that it relates to has not been sold yet, right? That is why we cannot include that in our profit or loss for the year. And that is why it is called other comprehensive income. So it increases your assets, but you haven't sold it yet, so you cannot say you've made the profit yet. Then some of them, I hope I'm answering your question. If I'm not, then you can just tell me afterwards. Then when it comes to those items, certain of them may in future be reallocated or reclassified to profit or loss, such as, for instance, a gain on investment. So let's say, for instance, let's say you bought shares for 100 rands many years ago, right? You bought one share for 100 rands, just to make it easy. Then at the end of, let's say, the 2019 year, that share, that one share isn't worth 100 rands anymore. It is now worth, let's say, 1,000 rands. Then you are going to show the value under your assets, financial assets. You're going to show the value of that share as 1,000 rands. But now you haven't sold the share yet, so you're just going to recognize that increase in the value since you purchased it of 900 rands as other comprehensive income, and you're going to call it a gain on investment, right? But let's say now in the 2020 year, you sell that share for 1,200 rands, right? You sell it for 1,200 rands. So that means you've already recognized the gain of 900 rands last year, but you haven't recognized the additional 200 rands yet. So in total, you've made a profit now. Now, once you've sold it, you've made a profit of 1,100 rands, right? Because you bought it for 100 rands, you're selling it at 1,200 rands. So in total, you've now realized a profit of 1,100 rands. But you've already recognized the gain of 900 rands last year. So you only now need to go and realize a further gain of 200 rands, but now you've realized the full profit, the whole 1,100 rands. So that means the 900 rands that you've recognized as a gain last year, you must now take out of other comprehensive income and add that to your other income to recognize it as part of your profit or loss, plus the 200 rands that you've now made a profit this year. Does that make sense? And then you get other categories, such as, for instance, the one where you have got an increase in a revaluation reserve, or where you've got, let's say, foreign exchange. Many of your assets might be in Britain or America, so they are denominated in a foreign currency, and when you then convert that currency into rands for reporting purposes, you might make a gain because of currency fluctuations. but those gains haven't been realized yet, so it can only be shown as other comprehensive income, but it is not allowed to be reclassified to profit or loss. So what we are saying in the other comprehensive income section, you might only have one of them. You might not have both. You might even have no other comprehensive income. But if you've got more than one type of other comprehensive income, and one is allowed to be reclassified to profit and loss and the other not, then you've got to show them under separate subheadings. One subheading item that may not be reclassified to profit or loss, and then you mention the nature of the item, and then the other subheading for the other item. Does that answer the question? Perhaps you can just tell me.
Yes, sir. Thank you so much. I'm clear.
Okay. Okay, perhaps you can just, I know it's quite a hard concept, but perhaps you can just listen to it again on the recording when we did the little whiteboard part and this explanation. So it's just a question of separating items if you've got more than one item of other comprehensive income and one is allowed to be reclassified and the other not. You also had a second question.
No, sir. It was just that I had.
With that one. Okay, fantastic. Thank you so much. Okay, so the last part that we've got to look at from a theory perspective is the notes to the financial statements. When it comes to the notes, there's a specific paragraph. I must just try and find it that I want us to look at. Looks like it's paragraph 112. Again, here you will have to make a few notes. The paragraphs I want to look at is 112, 114C, as well as 117. And once we're done with the notes, ladies and gentlemen, I'm pretty sure you'll be overjoyed that we're done with the theory part. And then next week, Tuesday, we will carry on with applying this into practice. Not only IAS 1, but also the conceptual framework. Then we are going to draw up the financial statements in terms of these two documents. So if you look at paragraph, what was the first one I wanted to look at? 112. When it comes to the notes, as we've said yesterday, these are not random little scribblings that we refer to as notes. They also have a structure and they also have specific content, right? And here we find initially in paragraph 112, they say the notes shall present information about the basis of preparation of the financial statements and the specific accounting policies used in accordance with paragraphs 117 to 124. I'm just going through this paragraph. We're going to discuss it in more detail soon. Also disclose the information required by IFRSs that is not presented elsewhere in the financial statements. We're going to discuss that soon as well. Then C, provide information that is not presented elsewhere in the financial statements, but is relevant to understanding any of them. So we're going to discuss that soon. I just want to see why I marked paragraph 114C as well. Yes, this is where we're going to discuss more detail. So where I want you to make notes now, our notes of notes, if you know what I'm saying, I want you to make a few notes. What is going to be the structure and the content of our notes to the financial statements? Now, you remember yesterday we spoke about compliance with IFRSs. You remember we said that if a company or any other kind of entity for that matter, if they fully comply with the international financial reporting standards, they must state that fact. You remember we said that? Do you remember we said that? Yes or no? Did we? Type for me. I'm just checking whether I haven't talked you to sleep. Yes, thank you, Naomi. Yes, thank you, Sinivuyo. Yes, so we mentioned that yesterday, and we said we're going to start our notes with exactly that statement. We're going to call that statement the statement of compliance. So the very first note that we are going to present, and we're going to follow a structure here, is the statement of compliance. Now, please, ladies and gentlemen, make a note of this. I'm not going to go back to the blackboard, to the whiteboard in this case. If you can just write down the note, what is that note going to look like? You are literally going to write the following. You're going to type or write there the annual financial statements, have been drawn up. You can choose your verb here, has been drawn up or has been compiled, whatever verb you want to use. But anyway, the gist of it, the important part is the annual financial statements have been drawn up or have been drafted or have been compiled, whatever your verb is, in accordance with international financial reporting standards. So you write all of that out. That is your statement of compliance. I hope you've all got that. If you haven't, listen to the recording afterwards. I just want to warn you, ladies, when it is a positive statement. You are the accountant of this company. You are telling the users of the financial statements what you have done. So you are basically saying, I, as the accountant, I have compiled the annual financial statements in accordance with international financial reporting standards. So you are stating what you have done. You are not teaching somebody else how to do it. Why I'm saying that, very often I find, sometimes, not too often, but sometimes students write there in their statement of compliance, the annual financial statements should be drawn up in compliance with international financial standards. You don't want to say should be. You're not telling the users how they must draw it up. You're not teaching them financial accounting. You are telling the users what you have done. So you're making a positive statement. You're saying the financial statements, the annual financial statements of my company have been drawn up in accordance with international financial reporting standards. Right. So that is our very first note. Our second category of notes are all the various accounting policies, right? So if we've got a specific accounting policy for property, plant, equipment, we'll describe the policies here. If we've got a specific accounting policies with regards to inventories or financial assets or financial liabilities for that matter, then we're going to then supply our various accounting policies in the next notes. The first one amongst our accounting policies is what we describe as the basis of preparation. If I can just go back here, under the structure of the notes, they say the note shall present information about the preparation, the basis of preparation of the financial statements, right? So that will be under our accounting policies note. We're going to give that note a name. So let's say number 2 is our accounting policies, then 2.1. The first note under our accounting policies, number 2.1, is going to be basis of preparation. Basis of preparation. Again, I'd like you to take a note here. What will be a typical basis of preparation note? We are going next week, when we put this into practice, I'm going to, or Mr. Borman, either the one or the other, or both of us will give you an example of a statement of compliance note as well as a basis of preparation note. So we will give it to you. It's also under the last year's papers on Blackboard. So a basis of preparation note will typically be the annual financial statements have been drawn up or have been compiled or have been drafted. You can choose your verb again, using, and then you describe the measurement method, using the historical cost basis or using the fair value basis, you're going to describe that. If that is the only basis that you use, that will be, then you'll put a full stop there. If you are using different bases for different categories of assets, then you will have, let's say you will start again with the financial statements have been drawn up on the historical cost basis, and then you'll say except for. So let's say you're using the fair value method for your property, for land itself, right? Then you'll say except for land or except for fixed property, which uses the fair value method, full stop. If there had been no changes in your accounting policies in with regards to the basis of preparation, you'll only have one further sentence there. If you did have a change in the accounting policies, then you'll have to describe a little bit more, but we won't have that in financial accounting 2. In financial accounting 2, we're not going to change our accounting policies yet. We'll do that at a more advanced level. So your next sentence will be that these policies, in other words, your basis of measurement, your measurement basis, these policies are consistent. In other words, to make comparability possible. So these policies are consistent in all material respects. These policies are consistent in all material respects to those applied in previous years. Right, so these policies are consistent in all material respects to those applied in previous years. If there had been a change, then we will describe that separately. So then you describe all your accounting policies. The next type of note would be supporting information for items presented in the financial statements. So that is where you are going to describe further disclosure, where you're going to disaggregate, let's say, for instance, property, plant, and equipment. So it's an item that is already in your financial statements, but you've only got an aggregate there. You've only got the total for all your property, plant, and equipment. Now you're going to provide further information about that item. So now you're going to have in your note supporting information. So it's going to tell the reader that 5,200,000 rands, that is property, plant, and equipment, consists of the following. It consists of motor vehicles with a cost and accumulated depreciation and carrying amount of X. It consists of plant and equipment with a cost, an accumulated depreciation, and a carrying amount of Y. And it consists of, let's say, what did I mention here? Motor vehicles, did I mention that? But anyway, any other kind of non-current asset, what was the cost or the fair value for that matter, if you are using the fair value measurement method, less accumulated depreciation, less something we'll talk about next quarter, which is called accumulated impairment losses, but eventually you get your carrying amount, right? And then, ladies and gentlemen, one other thing which they call other disclosures, and that is additional information such as contingent liabilities or unrecognized contractual commitments. What I want you to perhaps just understand or make a note of here, it is other disclosures. So it's further information provided, but it is not information that you find in any of the other financial statements. Under this paragraph 3, it is supporting information for items already in the financial statements. These are additional information about items that are not elsewhere in your financial statements, right? The example, they mention a few examples here, such as contingent liabilities or unrecognized contractual commitments, non-financial disclosures, and so forth. So let's maybe talk just briefly about those. What is a contingent liability? A contingent liability is a liability that may arise. It hasn't arisen yet. Remember, the definition of a liability is that there must be a present obligation. So in the case of a contingent liability, there is no present obligation yet, but there may arise in the future a present obligation. The best example I can think of to explain a contingent liability is, let's say, for instance, you have a shop like a pick and pay store, and there's a cleaner that is they are washing the floors and they forgot to put up a slippery when wet and slippery be careful sign or notice, and then a customer walks there and slips on the wet floor and they break their leg. Now, you know how people work now. They go to the hospital. It costs them, let's say, 30,000 rands in hospital fees to get the leg fixed. But they claim damages from you for 30,000 medical fees and 3,000 rands for emotional trauma. You know, that is the way things are, right? So they claim against the company. There might be a claim of 3 million rands of damages against the company, but the company does not know what will happen to that. You know, that will now become a court case. They're suing the company for damages. So that will now be presented in front of a judge in a court of law, and we do not know what the judge will decide. The judge may decide that person was negligent because he was walking with slip-flops on a wet floor, so it's not our fault. There's going to be no damages awarded. Or the court may find, yes, our company was negligent because we didn't cordon off the area, or we didn't have a proper sign-off up. So that person is going to get awarded the 3 million. Or the judge maybe decide that emotional trauma is exaggerated, but we are going to allow them damages for 30,000 rands medical cost. The fact is, at this point in time, before that court case has been finalized, there is no present obligation. We cannot quantify what we owe because there is no liability yet, but it might be useful to the users of the financial statements. They might be interested in fact, it might be essential in their decision making that they are aware that there is this kind of sword hanging over the company, that it is possible that maybe next year there could be a claim and a liability emanating from that of 3 million rands, right? So that is typically a contingent liability. Unrecognized contractual commitments, we also mentioned something similar yesterday, where the company has committed itself. They've signed an agreement with a supplier that next year or the year after, they are going to be acquiring items from that supplier for 5 million rands. So they are committed contractually, but they haven't concluded the transaction yet. So the liability is not in your statement of financial position yet. It's not part of your non-current or your current liabilities, but you have committed yourself in eventually acquiring capital, let's say capital expansion, a new plant or new equipment from a supplier, right? So basically we've got the categories. We start with our statement of compliance. Then we've got our various accounting policies, the first one being our basis of preparation, then the various notes that support the information already in our financial statements, that support inventory or supports intangible assets or supports financial assets or whatever, supports revenue for that matter, your profit before tax note, and then other disclosures about items that are not already in your financial statements. Okay, ladies and gentlemen, that concludes our discussion of IAS 1. That is all the theory that we need to know. So next week, we are going to start applying this in practical situations. So we are going to start drawing up the actual financial statements. Okay, thank you so much. Let's just maybe ask, are there any questions from your side? Are there any questions, something that you would like to ask about either Tuesday's or yesterday's or today's work? So we all, yes, maybe we can just ask that, Mr. Borman correctly asked that when is, oh, thank you, Sinivuyo. I also enjoy your company. Uh, you are all very, very, very welcome. We can perhaps just, yes, it's just past one. So would you like it to be our next session on Tuesday? I know Monday is a public holiday. Mr. Borman also asked there when will be our next class. Would it be all right with you, Mr. Borman, Tuesday? Or would you rather prefer Wednesday? Okay, students, you all happy with that? Mr. Borman also says Tuesday is okay. Mr. Borman says Tuesday. You all happy? Just raise your hands if you're happy. Thank you, Jalita. Thank you, Sinivuyu. Okay, so we'll have it on Tuesday again, Tuesday at 11 o'clock. Thank you, Bobby. I will thank you for all the hands that have been raised. Bradley Bizwapi, thank you. Gadlela, Molatisi, and everybody else. There's a lot of hands raised. So thank you for that. So we'll have it on Tuesday. On Monday, I will send out a guest link again. But all of you now know how to get into the session. If you're a full-time student on the Cape Town or the District 6 campus, you can just go to virtual classroom. If you're from another offering, Wellington or part-time, then you must just click on the guest link. So I'll send that out on Monday, and then we'll see one another again on Tuesday. Bradley Bizwapi, yes, you've got your hand raised. Would you like to ask a question, or is it still for saying Tuesday is okay? Tuesday is okay. Thank you so much, Bradley. And again, thank you for thanking me yesterday. I appreciated that. And everyone else today as well. And Kubile, Sinivuyu, it really is a pleasure working with you guys. You know, I sometimes think I regret my own family in favor of students, but you know, sometimes you do not realize how your lecturers actually adore you. We love working with you. So thank you so much as well, and thank you for the thanks. Then we'll see one another on Tuesday if there are no further questions. No further questions? Okay, then I'm going to stop the recording now. Thank you for attending, and then we'll see you on Tuesday. That will be hopefully more exciting than my voice. So we're going to put all of this in practice. Bye-bye. Have a good long weekend. Cheers.